Understanding Market Cycles in Property Investment. By Dr. Pooyan Ghamari, Ph.D., Swiss economist. Real estate investment can be highly rewarding, but understanding market cycles is crucial for optimizing returns and minimizing risks. Real estate markets go through predictable cycles characterized by periods of growth, stability, decline, and recovery. Recognizing these cycles and understanding their implications can help investors make informed decisions and strategically navigate the market. This comprehensive guide delves into the key phases of real estate market cycles, their indicators, and effective strategies for leveraging these cycles to achieve optimal investment outcomes. The phases of real estate market cycles. Expansion. Characteristics. The expansion phase is marked by increasing demand for properties, rising property values, and heightened construction activity. This phase is typically driven by economic growth, low unemployment rates, and favorable lending conditions. During expansion, there is a robust demand for both residential and commercial properties. Indicators. Key indicators of expansion include rising property sales, increasing rental rates, and a surge in new construction projects. Low vacancy rates and high investor confidence are also common during this phase. Additionally, there may be an uptick in homeownership rates and new housing starts. Investment strategy. During the expansion phase, investors should focus on acquiring properties in high-demand areas. This is an opportune time for development projects and value-add investments, as rising property values and rental rates can significantly enhance returns. Investors can also consider leveraging favorable financing conditions to expand their portfolios. Peak. Characteristics. The peak phase represents the zenith of the market cycle, where property values and construction activity reach their maximum levels. The market is highly competitive, and property prices may be overinflated. During this phase, the pace of growth slows, and there may be signs of an overheated market. Indicators. Indicators of a market peak include a slowdown in property sales, plateauing rental rates, and property prices that may seem unsustainable. High construction activity continues, but signs of oversupply may start to emerge. Additionally, there may be an increase in speculative buying and investor exuberance. Investment strategy. At the peak, investors should exercise caution. It is advisable to avoid overleveraging and consider selling non-core assets to lock in gains. Diversifying investments and maintaining liquidity can provide flexibility to seize opportunities during subsequent market phases. Investors should also focus on risk management and prepare for potential market corrections. Contraction. Characteristics. The contraction phase is characterized by declining demand for properties, falling property values, and reduced construction activity. Economic downturns, rising unemployment, and tightening lending conditions often trigger this phase. During contraction, market sentiment is generally negative, and investors may become more risk-averse. Indicators. Key indicators of contraction include decreasing property sales, declining rental rates, and increasing vacancy rates. Construction projects may be halted or delayed, and investor sentiment becomes cautious. There may also be an increase in property foreclosures and distressed sales. Investment strategy. During contraction, investors should focus on preserving capital and managing risks. This is a good time to evaluate property portfolios, perform necessary maintenance, and prepare for opportunities during the recovery phase. Bargain hunting for undervalued properties can also be advantageous, as distressed assets may offer significant upside potential in the long term. Recovery. Characteristics. The recovery phase follows the contraction and is marked by stabilizing property values, increasing demand, and renewed construction activity. Economic conditions begin to improve, and investor confidence gradually returns. The market starts to recover from the downturn, paving the way for the next expansion phase. Indicators. Indicators of recovery include rising property sales, stabilizing or increasing rental rates, and a decrease in vacancy rates. Construction activity starts to pick up, and lending conditions become more favorable. There may also be an increase in job growth and consumer spending. Investment strategy. In the recovery phase, investors should look for opportunities to acquire properties at attractive prices before the market fully rebounds. Value-add investments and repositioning of properties can yield significant returns as the market strengthens. Investors should also focus on long-term growth strategies and capitalize on the improving economic environment. Key factors influencing market cycles. Economic conditions. GDP growth. Economic growth drives demand for real estate. Higher GDP growth rates typically lead to increased employment, higher incomes, and greater demand for properties. A strong economy supports property value appreciation and rental income growth. Interest rates. Interest rates significantly impact borrowing costs and property affordability. Lower interest rates encourage borrowing and investing, while higher rates can dampen demand. Monetary policy changes can have a profound effect on real estate markets. Supply and demand dynamics. Population growth. Population growth influences housing demand. Areas with strong population growth often experience increased demand for residential and commercial properties. Demographic trends, such as urbanization and migration patterns, also affect real estate markets. Construction activity. The level of construction activity affects property supply. Overbuilding can lead to oversupply and declining property values, while underbuilding can create shortages and drive up prices. Monitoring building permits and new construction starts can provide insights into future supply trends. Government policies and regulations. Tax policies. Government tax policies, including property taxes and capital gains taxes, can influence investment decisions and market dynamics. Incentives for homeownership or real estate investment can stimulate demand. Zoning and land use regulations. Zoning laws and land use regulations affect where and how properties can be developed, impacting supply and market conditions. Regulatory changes can create opportunities or challenges for real estate developers and investors. Market sentiment. Investor confidence. Investor sentiment plays a crucial role in market cycles. High confidence can drive up property values and transaction volumes, while low confidence can lead to market stagnation or decline. Sentiment is influenced by economic indicators, market news, and broader financial market conditions. Consumer confidence. Consumer confidence affects demand for properties. When consumers feel secure about their financial future, they are more likely to buy or rent properties. Measures of consumer sentiment can provide early warnings of shifts in housing demand. Strategies for navigating market cycles. Diversification. Asset diversification, diversifying across different property types, residential, commercial, industrial, and locations can mitigate risks associated with market cycles. A well-diversified portfolio can provide more stable returns and reduce exposure to sector-specific risks. Income streams. Developing multiple income streams, such as rental income and property appreciation, can provide financial stability during different phases of the market cycle. Diversification can also involve investing in different geographic regions and market segments. Timing and patience. Buy low, sell high. Aim to purchase properties during the contraction phase when prices are lower and sell during the expansion or peak phases to maximize gains. Timing the market requires careful analysis and an understanding of market dynamics. Long-term perspective. Maintain a long-term investment perspective to weather short-term market fluctuations. Real estate is typically a long-term investment that benefits from patience and strategic planning. Focusing on long-term goals can help investors stay disciplined and avoid impulsive decisions. Active management. Property maintenance. Regular maintenance and upgrades can enhance property value and appeal, making properties more resilient to market downturns. Well-maintained properties are more attractive to tenants and can command higher rental rates. Tenant relations. Building strong relationships with tenants and maintaining high occupancy rates can ensure steady rental income, even during market contractions. Effective tenant management can reduce turnover and minimize vacancy periods. Leveraging technology and data. Market analysis tools. Utilize advanced market analysis tools and data analytics to identify trends and make informed investment decisions. Technology can provide real-time insights into market conditions and help investors stay ahead of the curve. Property management software. Implement property management software to streamline operations, reduce costs, and improve tenant satisfaction. Automation and data-driven decision-making can enhance property performance and operational efficiency. Risk management. Financial reserves. Maintain financial reserves to cover unexpected expenses and vacancies during market downturns. A well-capitalized reserve fund can provide a safety net and help investors navigate challenging market conditions. Insurance. Ensure adequate insurance coverage to protect against property damage, liability, and other risks. Comprehensive insurance policies can safeguard investments and provide peace of mind. Conclusion. Understanding and navigating market cycles is essential for maximizing returns and minimizing risks in property investment. By recognizing the characteristics and indicators of each phase, and employing strategic investment practices, investors can capitalize on opportunities and build resilient portfolios. Dr. Pooyan Ghamari, Ph.D., Swiss economist. Mastering market cycles requires a combination of knowledge, patience, and strategic planning. By staying informed and adaptable, investors can achieve long-term success in the dynamic world of real estate.